Thank you, Mr. Chairman. I suppose we could talk about fiscal sustainability in the context of the Laffer curve and whether or not a massive tax increase on the American people would stifle economic growth to the point where it would worsen, not help our deficit and debt picture. I'm going to resist the temptation to launch into that debate, but let me just ask any of you all, based on Professor Satina's point about the importance of fiscal responsibility, sustainability of our debt picture. I want to know what the tipping point is. Can any of you help the committee understand what is the tipping point? So we've got a $36 trillion national debt. That's 127% of our GDP. There are other countries, a handful of countries with higher debt to GDP ratios. Japan comes to mind, 250%, among the highest in the world. When do the bond vigilantes come? Does anybody have an opinion about that, where people start demanding much higher yield because it's a riskier asset? It is the safest, most deep liquid market in the world, but when does that cease to be? Can anyone offer an opinion on that?
So, Congressman, I've spent quite a lot of hours studying this exact issue, trying to find that number, that magic number of percent of GDP or however else you want to couch it. But our opinion within our strategy group at Bloomberg Intelligence is we're very close to that level where, not that you'll just see a massive sell-off in treasuries, but that treasury sell-offs will become somewhat more pronounced and rallies will be shallower. So the treasury market at this point, and I think given the fact that we are the reserve currency, we do have a very broad ownership base and buyer base and reasons for people to own it, it will continue to be cyclical with interest rates or with the economy, but they're not just going to randomly sell off to say 10%. We're not an emerging market. Until the reserve currency changes to something else, the U.S. Treasury market, I think, will remain deep and liquid.
Professor?
Yeah, I just wanted to make a point. There's a beautiful piece of research from the St. Louis Fed called What About Japan? I highly recommend people on this committee read it. Basically what they do is they nicely debunk the point that Japan has higher government debt to GDP, therefore we should find solace in it. They point out that the Japanese have significant foreign asset holdings, which tend to, when you net those down, ameliorate their debt to GDP level. I just highly recommend it because What About Japan is often invoked to say, let's continue on our.
Well, thanks. One final editorial comment is, look, growth won't solve the whole problem. Obviously, fiscal discipline is imperative, but we should focus on growth because the more this economy grows, the less that debt is relative to our overall GDP. Let me talk about Treasury market structure a little bit. That market has grown dramatically since the pandemic, from $17 trillion to $29 trillion today, and it's expected to double in size over the next 10 years. As that market grows, obviously we need market participants. Let me ask the banker, Mr. Werfel, why are banks important intermediaries in a growing Treasury market?
Thank you for that question. I think the Treasury market, unlike some other markets, is an over-the-counter market, which means it relies on intermediaries to move securities and cash from one buyer and from buyers to sellers. So intermediation is essential to the Treasury market. It's one of the reasons that we think that improving intermediation and supporting intermediation is quite important. We've laid out a number of steps to do that. It can improve market safety. You can support market liquidity venues, but importantly, we think targeted adjustments to the leverage ratios, both the SLR and the Tier 1 leverage ratio, would be important in helping to support the Treasury market's intermediation capacity. Those ratios today constrain banks from being able to intermediate, especially in times of stress. It was intended to be a backstop, but now it's a constraint.
Yeah, Professor Duffy, can you also talk about the importance of adjusting the SLR? I think there is a consensus developing that the Fed is impairing the liquidity of our Treasury markets by not recalibrating the SLR.
Yes, Mr. Barr. It's indeed, the SLR is indeed a distortionary form of capital buffer. It should be changed without, in my view, reducing capital at the banks. As you said, the Treasury market has grown by leaps and bounds. The main concern is that the banks themselves have not been able to grow as quickly as the Treasury market. So as I answered to Mr. Hill, the market capacity has to come from somewhere else, including all-to-all trade.
Well, that's the short-term solution. The long-term solution is growth and fiscal discipline. I yield back.
Gentleman yields back. The chair now